Cloud. All right. Welcome everyone. This is Saturdays with Eddie. Today is February the 4th, 2023. We're calling this edition Love is in the Air. It's February, right? So this is kind of a happy month for a lot of couples, I guess. I don't know. I couldn't come up with a better theme. So I decided to call it Love in the Air. We're going to define that here, throughout the day today. We'll see whether that rings true for all of us. Saturdays with Eddie is one of those sessions that we hold every other week. So if you're here today, don't come back next week. Come back the following week, right? So it's every other Saturday, 11 o'clock Eastern time. It's not come rain or shine. If we have things to do, we cancel it, right? So yeah, life does happen. So if there's something, or there's just not enough juice to go around, then we'll cancel it. But in general, it's every other week on Saturdays. We talk about options primarily. That's all we do, options with Eddie. We talk about shares every once in a while. But the idea is to talk about options because those are leveraged. We know that once you're doing options, there's not much else. I'm seeing myself twice. All right, there we go. What else? This is for educational content, not financial advice. So if we have a few tips here and there, it's not so that you can go do this on Monday. Don't do this on Monday, right? You gotta have your due diligence. You have to understand what you're doing, and don't just blindly copy trades or strategies that you're not familiar with. By all means, do your due diligence. Do some research. Ask questions. In fact, questions are very, very much encouraged here. Go ahead and stop me if you can. It is not rude. I don't take any offense. Just you need to ask a question. Just go ahead and ask it. So that is one of the hallmark features of this, where it's a two-way. I don't want to be talking all the time. I need to be able to catch my breath. So I welcome that interruption. If you're new here, welcome. Who is this for? It's for basically everyone. You don't have to have been trading options a long time. You can maybe have heard about options this morning, clicked on a link and found yourself here. So today we're actually going to try and go back to basics. We're going to answer a lot of questions that new people ask. So it might be a little boring for those who've been here before or have traded options a lot. Bear with me, because that's what these Saturdays are for. They're for everybody, from beginners all the way to advanced. If you've been trading options for years, cool. So let's see what else. Any questions so far, or anybody has any topics that they want to discuss? Any burning questions? Yes, no, maybe. Anybody want to give a shout out to what they did this week? By the way, the list this week was a pretty good week, except for yesterday when they kind of shook people a little bit up, right? Yeah. So, anybody came out alive yesterday? Mary, what do you think about yesterday? Mary's not talking. I know Wiletta's she was trading yesterday.
I'm sorry, Eddie. I was muted and away from my computer, but I came out alive.
You came out good.
I thought I was dead one time.
Yeah.
Yeah, I was ready to say cover me up, but late in the afternoon I came out alive and followed you to the bank.
Awesome.
Did that U-turn, followed you to the bank.
Yeah. Oh, okay. Yeah. in the morning, I tried to get directions to the bank, and I was like, I missed the exit completely. It's one of those exits where you have to drive like 10 miles to turn around on the turnpike. Yeah. So that's a metaphor for I was losing money. Bleeding red, until it turned around, had to do some maneuvers. And that's a good thing about when you know what to do, right? But I came back from, I think it was negative 2,400 to about 700 in the positive. So that was, I consider that okay. Yesterday I was just fighting to break even. So cool. Anybody else have a story like that?
Yeah, yesterday I had the confidence that it was going to fill the gap. So I was kind of patient.
Yeah.
Though it was going a little bit slowly, I came out green.
I see what
Nice.
Yeah, it was a slow gap fill yesterday.
Yeah,
So after
extremely
it filled
slow.
the gap, then it made a reversal.
Yeah. I was also confident that it was going to fill the gap. And that was probably one of my undoing because as I was waiting for the gap to fill, it did not fill completely. And so when it started coming back down, I'm going to share my screen here. So hopefully you all can see this. I'm pretty sure you can. Yeah, so yesterday as it was working on filling this gap here, notice, where is it? Yeah, that was this gap here. It wasn't filling it completely. I thought it was going to fill before it dropped, and then later it came back and filled it. But the decay of premium from this candle over to maybe even 2 or 3 other candles here was significant enough. It was I guess the power of theta. When you have a 0 DTE trade, then that really sucks. So
Eddie, did you miss the first when did you get in?
the run up.
Uh-huh.
So I believe I was in the wrong direction first.
Oh, okay, got you. Okay, got you.
So on the first candle, because we had such a huge negative ES,
Right.
my thought was that we were going
We're
to
going to
fill
go
this
down.
gap.
Yes.
And so I went in heavy on this one.
Okay.
With a lot of confidence that we were going to fill this gap below.
I see.
And they proved me wrong fairly quickly.
Mhm.
So I got stopped out, and that was
Okay.
good. So my stop loss worked very well in my favor, and it was a negative, 2.5. So I had a $250 stop loss on 3 contracts. So I was trying to make it up, and then because I wasn't so sure about the gap, I was very late to get in on this.
Okay.
So to get in on this gap fill, and I guess I waited too long. So since when it reached this point of no return, I thought, well, this gap is going to fill up.
Mm-hmm.
Then I got into a call.
Okay, but then you had there was not much movement.
But then it started pulling back
Yeah.
down, and I was in the red throughout.
Right.
At one time it was positive because I was sure it's going to fill, but it never filled. There was this, maybe go to the 1 minute. We can maybe see. Well, that's too much detail. But anyhow, I was about maybe 1, 2, 3 points away from the gap fill, and it refused to fill the gap. So my premium was just decaying.
Okay.
And then when I finally got out with like $100, I was like, well, this is what's happening.
Okay. And then you were able to catch it on the way down.
And then on the way down, I caught it on the way down to try and recover all the losses from the earlier morning. So I got out. I think when it reached about here, I was way up, took my profit, closed the computer. You guys, I posted my message over there. But it did continue to go down. What's that?
Why are we looking at Google?
Why are we looking at Google?
Mm-hmm.
You know what? This chart does look a little funny. I was wondering why it looks like Google, right?
Yeah.
Yeah.
You were trading Google, were you?
Yeah. That's why this is looking a little funny.
Okay.
Yeah. This consolidation here.
Right.
This consolidation here. But on this candle is where I made my money back.
Yes. Okay.
Yeah. Now, had I known that it was going to go all the way down, then obviously, I'd have been a happy camper. But by this time I was bruised. I was, just barely licking my wounds, and
it's better to get out than
get out. So I didn't realize I was looking at Google. Why was I looking at Google?
I have no idea.
Yeah, I don't know. I must have clicked off something.
Yeah, because the chart looked funny to me. I thought, I don't think that was SPX.
Yeah.
Yesterday.
So
but the winner yesterday was Apple, though. Apple is what did it.
It just went up and then consolidated.
Yeah, in terms of bringing it up.
Yes.
That's what because I was watching that. That's what I realized it wasn't going to go down. It's going to go up. So it was too strong a move on Apple.
Yeah. And even in the morning, I think Meta was strong in the morning before
Meta
it
was
pulled
strong
back.
too. Yeah.
Yeah, before it pulled back in the afternoon. I think also Amazon was.
Amazon, yeah. So there were lots of them pulling it up. So I
Yep.
thought, yeah.
Mhm. They did end up down. I think Amazon did end up down.
Yes, they turned, but
So,
Apple really was strong because Apple was up like 10
Mhm.
bucks at one point.
yeah. So cool. Yeah, yesterday was definitely I would say it was a CCS day if you had gone for the 80, which was my original thought, 4180. Because I did consider selling in the money. But then I was kind of glad I did not sell. No, so it was somewhere here, 4180. It did get breached over here.
But it would have been okay if you held it.
Would have been okay, but I wasn't thinking straight. When you're in the red, you're not thinking very straight.
Right.
But 80 was the right thing to sell yesterday.
Mhm.
PCS, I would not have touched a PCS.
No.
So, cool. All right, let's build a small agenda, guys. What
Hey, Eddie, I have a quick question for you. As you were showing Google, if you look at the 5-minute chart, it's quite interesting because you see large wicks on the bottom, which will have told you that there are buyers stepping in when you say that.
So I'm looking at Google again, and what am I looking at here? 5 minute? Did you say 5 minute?
Yes.
Okay. This is the 5 minute on Google.
You see all the way when it was going up, and then those candles with the wicks, right?
Yeah.
This shows that buyers are stepping in, and then we should expect another push up. But then you also see the double top, which shows that the guy has also difficulties to going up.
Okay. I guess that's one way of explaining it. I've never really thought about where buyers are and sellers are. I've heard those terms used. What I refer to them as is they're either bullish or bearish candles, right? So I would say this is as you say, these are bullish candles, meaning that even though the candles are red, you notice that the body is on the top. That's how you have to interpret that those candles, right? When you have a strong upper body, a longer wick at the bottom, then you know that that's a bullish candle, regardless of the color of the candle. So, but yeah, you do have a good point there. The buyers or the bulls are pushing the price up.
And this was also right on VWAP itself too. Right?
Yeah.
Really like a bounce on VWAP.
You said viewer?
The VWAP, the volume weighted average price.
Oh, okay. The VWAP, yes. The volume weighted average profile, yes. So he's talking about VWAP, which is a metric that not a whole lot of people know about, but something that we can possibly talk about in an advanced class. VWAP, VWAP, is a volume profile metric that some advanced traders will use to determine how are we looking. They usually actually base that on the VWAP on ES or SPX. That's where you normally hear the VWAP being used a lot. So, okay. Yeah, but yeah, I'm glad that you're actually interested in VWAP. I might even talk about that sometime in one of my advanced classes. See how you can use that metric to gain an advantage. Cool. All right. So who's here for the first time? Anybody here for the first time? Or has a burning question that is either advanced, not advanced? I mean, whatever kind of question. Who's here for who's new?
I'm the first time here, but not really new. I'm with Daily since what, 2020?
Okay. Good. Welcome.
Thanks.
Yeah.
And I used to like your classes there too. When I saw your name, I said I need to step in. Come.
Yeah. Welcome. Yes.
And thanks, Gail, for organizing all that. It's really great. Thank you.
No worries. Yeah, this is open for everyone. Yeah, we don't We don't push anyone away, no matter where they're coming from. Whether you paid $0 or whether you paid $10,000, we don't really care, do we? All right, Willetta, what's up?
Just saying good morning. This is my first time joining your live Saturday session.
Nice. Yeah, Willetta is one of my star students. She's just killing it. You're still killing it over there in the good old land of Texas?
Trying to, and I was looking at your trade on SPX yesterday, and I didn't take it because I had a very busy day at work, but that was the exact trade that I had thought about putting on.
Yeah, the 4180.
Yeah.
Yeah, that was probably, if I had my head right yesterday, that's what I've taken. Recently, I've been taking a lot of CCS trades, call credit spreads.
Yep.
And the reason for that, I'm going to switch back here to the 15 because I don't like the 5 minute. The reason I've been doing that a lot is it's easier to identify how far of a movement we are expecting upwards.
Yeah.
And for that reason, you have more confidence that we're not going to rally up so strongly, except for Thursday when the Fed was speaking. Was it Thursday or Wednesday? One of those days?
It was Thursday.
Thursday, yeah. So on those days, you don't do anything. You just chill on the sidelines. You go for a walk, go golfing, go shopping, whatever. Yeah, if FOMC activity is happening, then you want to stay away from the market. Even experienced traders just sit on their hands. Cash is a position, as we say.
Yes.
Right. Yeah. So
I got burned on one of those days.
Yeah.
Much earlier on, and so when Fed is speaking, I'm just out the market on the sideline.
yeah. Cool. So let's ask some basic questions that should get a feel for where everybody is at. Is there anyone who's confused about what to do when they open their platform, or how to trade? Do we have any beginner traders that need help understanding what are options? How do you actually make money? How do you not lose money? I guess that's more important. How do you not lose money on this? Because you can make a lot of money and you can lose a lot of money. So do we have anybody with those kind of questions? Or do you want to go straight into advanced topics? It's an awkward silence.
Eddie, on Thinkorswim, how can you chart on a different screen using Thinkorswim while you're also trading on the same platform? Because I find it difficult trying to toggle between the trade tab and the chart to kind of monitor the movement of the candlesticks.
Yeah. So your question is related to how do you manage this screen as well as this one?
Yes.
That is a question. Okay.
Yes.
So if you don't have multiple screens, it becomes a little challenging, or if you don't have a large screen, right? So you could do several things, right? The easiest one would be to buy another monitor and then attach it. Yeah, don't kill me. Don't kill me. The other way you could do is to detach your chart.
Okay.
So you notice that I have detached my chart here, and I can resize it, do something, get even multiple charts, and look at different things here, right? That's
Okay.
one way. It works very well if you have a separate monitor and you can move these to the side. For example, I just moved mine to the side over here. That's one way. It can get confusing. The other way is to simply create another chart over here. So notice that I just resized my left side,
Mm-hmm.
and I'm going to push the plus sign at the very bottom of my screen. I'm going to add a quick chart, right?
Okay.
I'm going to give it the color symbol here, blue, so that it synchronizes with my current view. Do you see what I'm doing over here?
Yeah.
And then now I can go back here to my right side and I can see both at the same time, right? So I can, make these as big as I want or as small as I want. And there we go. Change the time frame here from maybe daily to, I don't know, do you trade on the 15-minute?
I trade 5 minutes, 1 minute.
5 minute and 1 minute?
Yeah.
You need to stop. You need to stop that, man. So I'm assuming you're day trading. Is that what you're doing?
I do, yeah.
Okay, if you're day trading, then 5 and 1 minute is okay. But for most people, you pretty much want the 15 and the daily. So, and let's talk about that for a second. When you're trying to make a decision, if you're just doing regular trading, then the daily helps you understand your long-term perspective, where you're going. So that's the decision. And then the 15, you're trying to figure out what's a good time to get in. It really doesn't matter too much what time you get in if you're doing a swing trade, if your thesis on the long term, on the daily chart is correct. Yeah, so let's say that again. If you know how to read the chart, and most of you do, if your thesis on the daily, on the longer term basis, and I'm talking about longer than a few days, a week, 2 weeks, 3 weeks, if you believe that the price is, say, going to come down to 40, 50, then intraday, you don't care too much about the ups and downs of that ticker symbol. Anybody disagree or agree with that? Anybody have an opinion on that? So that strategy is going to help you. By the way, I like a white background on my chat. So let's go with that. Apply that. I also like Fill App, and you can see how you can modify your chart to look just the way you want it. Okay. The doji, I like the doji to be maybe even black. How about that? Let's go with that. I'm doing some useless things here now. Okay. One more thing, I don't want to see the volume, right? This volume here is just taking up a lot of space. So on the price axis, I'm looking for, somebody remind me, how do I get rid of volume? I want to get rid of volume. Show volume. There we go. Apply. Yeah, it's in my way. So you can see here that I was just modifying my chart a little bit just to make it friendlier. And you can do that. And when you're done, make sure you save your workspace so that you don't have to do it every time. But what I wanted to stress here is when you are doing a swing trade, let's go with Apple. How about that? Apple. And you decide that Apple is going to maybe it has hit resistance at some point. I think it's hit some resistance it hasn't hit in quite a while, and it should start pulling back. So if your thesis is that it's going to come back down to this 145 level, then when you buy your contract, say 45 to 90 days out, then you don't have to worry too much about what it does during the day. As long as your long-term perspective is that it is going to come down here and it's going to take you maybe 5, 6 days, a week, whatever, and you're buying 45 to 90 days out, then your thesis says that you can buy right now. You don't worry about theta too much because you're that many days out, and it's just a matter of waiting. Does anybody do that? If you buy it and then start watching it during the day, you're going to get out.
Mm-hmm.
Yeah.
Yeah, I do that.
It's a really bad way to trade. If you're doing a swing trade, buy and then start watching it every 2 minutes or on the 5 minute. That's not a good thing. It's kind of like it's like buying real estate property, right? You buy your house for speculation because you've been told that house values generally go up. So you buy it today and Next week, you're looking to see whether the value has gone up. And the following week, that's nuts, isn't it? You wait 6 months, a year, 2 years, maybe. It's the same thing here with stocks. When you're doing swing trades, don't look at it every other minute. It's going to kill you. So that's a good question there. Good tip.
Thank you, Eddie.
Sure. I also use TradingView. I like TradingView a lot, by the way, guys. If you do not have TradingView, you should probably get TradingView. Yeah. Let me show you how TradingView looks like. Anybody know how TradingView looks like? Or not know?
Eddie, do you pay for, I noticed you don't have delayed time on the others. Do you pay for the extra time?
On which platform?
On TradingView?
I do, yes. I do.
The $3 a month? Okay, cool.
It's actually $5 a month. It's $5 a month. I think it's well worth it for me because I also trade futures, and for that reason, I need that real-time data. So you've got real-time on pretty much everything except for the futures. Now, if you have TradingView and you have the Pro version, then to upgrade, you simply go here. I guess you can click on, where do you click on? Maybe not there. To upgrade, somebody was asking me how to upgrade the other day.
Yeah, right there.
Was that you?
No.
I think here, accounts, maybe accounts and billing. I'm pretty sure. Let me see. I think you go to the pricing.
You go on the top left where you have
If you click on your face, it'll take you over there, I think. Like
yeah. Okay. Yep. And then I guess you scroll down. Yeah, you scroll all the way down and you see where it says what do you see? Yeah, pricing and futures and stuff like that. But anyhow, this is a good platform to pay for. If you're paying for anything, this is one to pay for. Now with Thinkorswim, obviously you don't have to pay extra for real-time data. You already have that by default. With TradeStation, I think you might have to pay a couple bucks extra. I think it's also $5 a month for the futures data. So most people who are trading just options don't need that extra data.
And Eddie, just to mention, it's good to buy it on a Black Friday. Usually they do 50% discount.
I agree. Yeah, the Thanksgiving area time frame. That's when actually I bought it because they had this huge sale. I think it was 50 or 60%, and I pay $108 a year for this. That's one SPY trade. Everybody understand that?
Yeah.
One SPY trade.
Yeah, Eddie, on the TradingView, which of the market data do you subscribe to? Is it the NASDAQ, NYC, ACA, or just the NASDAQ indices?
Let me find it. I'm paying for the CME group, E-mini included. Do you have one that's labeled like that?
Yes.
Right, CME group, E-mini included, and it says CME, CBOTs, COMEX, NYMEX.
NYMEX, okay.
Yeah, and I'm paying $5 a month.
Okay.
Yep. $5 a month. I'm over here trying to hide my account numbers. Doesn't look like I'm able to hide my account numbers. But when I view my billing history, so let me. I think I was able to hide it. So here it is. So this is what I'm paying for the CME group. It's paid monthly. That one is $5, and then the yearly is $108.
Okay.
Yeah. So very, very inexpensive way to bump up your trading. Strength or edge, if you will.
Thank you.
Sure.
But Eddie, that CME group is only for futures, correct? If you're trading futures.
Yes.
Okay.
Yes, that is correct. If you're trading futures, then it's important. Or if futures are important to you and you just want a different view, if you don't need it, you can always look at the futures on Thinkorswim, and that's free. On TradeStation, the futures data is delayed. Anybody know that? So on TradeStation, the futures data is delayed by at least 10 to 15 minutes until the market opens, which really sucks because you need that information before the market opens. So I thought I had this one. There we go. Okay. So that was a question for, I think we answered that question. I don't need this widget here anymore, so I'm going to take it off. What are the questions we have on the platform or in general, or the options chain or strategy?
Hey, Eddie.
Hey.
Hey, everyone. I'm not sure if this is, how much of the mix is new people and old people, but just wanted to share my experience from yesterday, if that's okay.
Yeah, that's cool. Yes, please.
So I did my first live trade yesterday and I felt really good about my thesis. Everything was going well. Went in and got stopped immediately as soon as I pressed the button. And I couldn't for the life of me realize why. This makes the case for always creating a template for your orders. I was at work and I was just getting to press the button. I did not review it all the way through, and I did not change my order from limit to stop. So I did a bracket order. I didn't change when to stop. Only lost $10, but I'm happy about this. But to learn from my mistake, go ahead and set up your templates now so that if you're in a rush or you can't really look at it, you already know that your template set and you can use that to place your order. Yeah.
So thanks for sharing that, Tanya. When you sent me that screenshot yesterday, it was apparent immediately to me what had happened. And let's demonstrate that. I'm going to use maybe just a slightly different scenario than what you had, because I think you had a spread. Is that right? Yours was a spread.
Yes, I did a spread, a vertical on a debit put. I did a put.
Put, yeah. So setting up a template is really easy. It's going to take you like 10 seconds, give or take, right? And let's say we want to set up a bracket order here, say with Apple. Notice that I just right-clicked on the Ask column and then selected Buy Custom and chose with OCO bracket, right? And then I'm faced with this default, Thinkorswim bracket order where it gets me to the current price, takes me out at $1 for profit and protects me on the downside with $1, right? So you can achieve that. I mean, normally you want to change these numbers. Let's do some quick math over here just to help us out. I'm going to go here to the 9 months, 1 day. This is my resistance point from 154. Let's say I'm looking for about $5 in premium. Okay, $5 in premium. So you could manipulate these and say I want 6 plus 5 and put in 13 point. No, 6 plus 5 is what, 11?
11.
So you could do that, or you could make it a little easier for yourself and actually break this chain, right? This chain link. And this time you see that the link here is a trigger, and you see a plus or minus, and you can put in however much profit that you're targeting. So $5 in premium, we know, is equivalent to $500. And so if I put a +5, what I'm telling the system is that whatever price I get in, go ahead and add 5 to it. Well, this padlock is locked, so it will only get me in at 6:30. If I want some flexibility, then I want to unlock that padlock. What's the difference? The difference is that when I submit this order, it is going to try and get me a price $6.30 or better when the padlock is unlocked. If the padlock is locked, I'm telling the system, I only want this price, nothing else. 6.31, nope. 6.29, nope. 6.30, yes. Okay, bad idea. Instead, get some flexibility, you get better fills, faster fills. That's number one. Second, because now this is relative to what the pricing is on the market, go ahead and do a +5. So it doesn't matter what you get in, you're looking for $5. And then do the same thing with your stop loss, break the chain. And if you want to, risk $1, that's great. If you want to risk maybe $1.50, you can simply do that. See how that works? So whatever price you get in, you're risking yourself on the downside. You're putting a risk on the downside for about $1.50. And that way you don't have to calculate what is 6.3 minus 1.5. 6.3 minus 1.5. Then you get $4.80. That's a lot of things to do. One more thing. Let's choose GTC on these, right? So I could click each of them and click GTC and all that. There's an easier way. Just click to link all of them, change them all in one setting. They're all now GTC. And then if you normally trade one contract, that's cool. If you trade, say, 3 contracts, go ahead and link that, bump it up. See how easy that is? So we're setting up our template. So I'll go back down here to 1. Most people should be trading just one contract. And it's GTC, so that's our green line. They're color-coded. That's our entry. That's our take profit. And this is our risk management. Once you're happy with your template, then you can save the custom order template. Do you see this icon right over here next to the word delete? So we're going to save this one. We're going to call this one the Tanya. How about that?
Too funny. I'll remember it now.
Yeah, we're going to call this one the Tanya. We're going to say +5, and we're going to risk 1.5. We're going to save that. Yeah. So how do you use that? Since we set it up on a put, can we use the same thing on a call? Can we use it on the ticker symbol? Well, let's see. I'll delete that. I'm going to go to Tesla, and I'm going to decide to buy a call, and I'm going to use the Tanya here. Look at that. Works the same way. It's GTC. It's one contract. Take 5, risk 150, open padlock, bada bing, bada boom, go. So you can set up as many templates as you want. There's no limit. If you don't need a template anymore, then you can also delete it. For instance, to delete one, you simply right click and then choose any of the customs here, go to the delete. And notice I've got a lot of them that I have actually done over here. Every time I set an example, I forget to come back and delete them. I even have one for 5-point wide debit spread, right? So that's how you delete that, and you click on yes on that side, and it's gone. Make sense?
Eddie, I'm sorry, but I can only see the your PY screen. I'm not seeing what you're doing. I'm not seeing the template.
Okay, that was Antonia. Who else can? What is everybody else saying?
We're seeing your option chain.
Yep, the options chain and the template that I was building and working with, right?
Correct.
Antonio, you might have to. What do you need to do? You got a strong internet connection over there?
Well, maybe it's
Eddie, I see it now. It was probably a delay in my phone.
Okay.
Okay.
Right.
Sorry about that. Thank you.
No worries, Antonia. Yeah, cool. Yeah.
Eddie, if you want to get in and out of a trade, say you want to do a +1 without putting a stop loss, is it possible to set up a template for that?
Yeah. It's called loading your gun and shooting your foot. Did you say without a stop loss?
Yes.
Yeah. It's called loading a shotgun and so here's how you do it. You can do by custom and actually it's really easy. Let's do that. Let's just go ahead and just click on that. All I did was click on the ask price, and then I'm going to change this from advanced single order, and I'm going to make these just fast triggers OCO.
Fast triggers, yeah.
Okay, and then I'm going to right click on this initial order. I'm going to create the opposite order. Okay, so this is my selling point. And then I want, you say you want to take how much? You want to take $1 profit?
Yes, just +1.
Okay, so I'm going to change this from manual to trigger, and I'm going to put +1.00. And do you want this GTC or not?
Yeah, GTC.
GTC is great. Okay, great, not great. Good till canceled.
Yeah.
Good till canceled. That's what that means. And we're going to save this. And because your name is very long, we're going to call this one the author. How about that? The author is just +1, right?
+1.
+1. And we're going to go, we're just going to go riskless. Or whatever you want to call it. This is a free form field. You can name it anything that you want, right? And then to use it, all you have to do is just right click, buy custom, choose the author. You're good. And you can use it on any ticker symbol as well. I know you trade, what do you trade these days? Trading SPX?
SPS.
There we go. So buy custom and take the author, go confirm and send. It's as easy as that. Do I recommend? No. Always go in with the risk.
Yeah.
So Eddie, I have a question. If we're doing a swing trade and let's say it's 45 to 90 days out, could we do the OSA and then later do a order replace, cancel and replace order and put this in at that point?
If you're doing a swing trade and you're only looking for $1, that's a really bad trade.
Okay.
We don't trade for $1 normally. We trade for at least $3 to $5.
Okay.
On each trade. So $1 here would be a quick scalping strategy, right? You're expecting a movement of about $2 in order to get $1. Yes. Right. And that's really easy on SPX. You can, SPX does move, in fact, fairly, quickly. So I'm going to drop here down to say the 15-minute. So what he's doing, he's probably playing somewhere here, and he's like, well, it looks like the price is moving. It's oscillating between 29 and say 39. So that's a 10-point movement. And so he wants to get in over here on a put. Maybe it moves $2 and he's got his $1. He's risking, right? And he doesn't want to have a stop loss because it's moving up and down. That's probably why he wants to do a +1. And also, I'm fairly certain he's probably doing more than one contract, maybe, I don't know. But yeah, that's a scalping strategy. I don't encourage that one, but you can do it.
But Eddie, assuming you were
Oh, sorry. Go ahead, Tanya. I was gonna say, assuming you were doing like the $3 or $5, like Tanya was asking, you could do the cancel and replace later as you get closer to your expiration.
Yes, you can. You can. And you can even add a bracket order after you've entered the trade.
Okay, can you show us that after do you have a way to show us how to add the bracket order? Is it similar to just adding duplicate line?
I think I might have some orders in play here. I have a MongoDB order here that I forgot that I had. It was a put. It's in fact losing money, right? So you can see the MDB trade that I have here, and I don't have any working orders. See,
Okay.
maybe I forgot to put in my GTC. That's probably what happened. Yeah, that's probably what happened. And then my order, just dropped off the system at the end of the day. So what I could do is I could create a closing order. Well, first I need to know how much I bought it for, right? Well, my trade price was $27.90 and it is now trading at 22. So I'm $507 down. So let's say I want to salvage this equation, right? And I have a strong thesis that it's going to come back up to $28, maybe even $32. That's number one. But I also want to protect myself even further and say, you know what, my thesis may not be correct. And so at $20, I want to definitely get out, at which point I will have lost how much? About $700, right? About 700, because the current price is 22. I bought it at $27.90. If I choose to stop myself out at $20, then I will have lost $27.90 minus 20, which is $790. If my thesis is that I want to make this 28 plus 5, what is that? 28 plus 5 is 33. So let's do that. Let's go 20 and 33. So that's a great question there, Tanya. So what I will do is I'm going to simply right click on this security here. I'm going to create a closing order. I'm going to sell one. And notice that it just gives me the default current price, all the good stuff. But that's not what I want. Instead, what I want to do is make this into an OCO order. So look at this. Advanced order, I'm going to change from fast triggers OCO or whatever it is. And I'm going to choose just a plain OCO. Once I do that, I'm going to right click on this line, the red one, create a duplicate order. There's a lot of steps, but we'll get there. So both of them are sell, right? Because I'm already in the trade. Okay. Next thing I want to do is I want to now put in my take profit order. So, by the way, notice one thing over here is that the confirm and send is not yet active because this order is not correct. So we're going to fix it. So my take profit is going to be 33. We've identified that we got into this order about 27.90, which is roughly 28, and we want $5. So 5 plus 28 is 33. Okay. And then we want to do a stop loss, $20. And right now we are at 22. The mark here is 22.85. So we are risking an additional $285 from where we are. Okay. So now that we have that, then I can go ahead and confirm and send, make sure that this one is GTC this time. Okay. So it's GTC and it's then the one order, confirm and send. You can see that we have two orders here, our take profit and our stop loss. Send. If I go back to my monitor, notice that I have a bracket. You see that chain link on this on the left side?
Mm-hmm.
So effectively what I just did now was I added a bracket to an existing order. Okay. I added a bracket to an existing order. That's what I did. And you can see it here. It says the spread type is OCO. It's related to order number 162. 6961427. So these are mutually exclusive. Mutually exclusive means that only one of them is going to happen, either the take profit or the stop loss. Only one of them is going to happen. That's what mutually exclusive here means. And it's a good thing to do this to an existing order, because when you failed to put the bracket in the beginning, a lot of times, previously all you could do was just, hope for the best, that you're going to remember about the trade and it doesn't lose too much more. So this is a good way to come back and salvage your trade, right? Your thesis here is being that price is going to come back up. Let's take a look and see if that's the case. So this is MongoDB. We just added a take profit here of, what was it? What was the trade? It's is it a put or is it it's a put. Okay, so it's a put, right? So our thesis here is that price is going to actually come back down here. And that looks like that was our original thesis. We were going to come back and take profit at this point. Okay, so the current price, I'm going to remove, clear the drawing set here. So current price here is 220. Our thesis was that it's going to continue dropping. Why am I on the? Yep, that is going to continue dropping. But in case it does not, then we should get stopped out here fairly quickly. So I think this is still a good trade, even though right now it's negative 500. But if this trend continues, you can see that we are going to get our $5 here. Does that make sense? But what we've effectively done is limit our losses to no more than $700 on this particular trade. It's not exactly a good trade at this point, because we're adding these brackets after the fact. Our stop loss should have been well before that. And what probably happened is that my time in force was day instead of GTC. Otherwise, this kind of trade I should have been kicked out a long time ago. Cool. All right. Who's got another question over here? It's kind of an open mic day today. I was going to go about the basics, but all of you have traded options for a long time, it appears. Is anybody not trading options yet? Yeah, I think everybody's trading options. Yeah.
I've been trading just a little bit.
What does that mean, Antonia? What's a little bit?
Maybe about a month.
Okay. So I've got a pop quiz for you.
Oh, please.
I have a question when Antonia is done.
Yeah. So I've got a pop quiz for Antonia. So when price is going up, what's the simplest strategy that you can take using options?
Okay, I'm gonna be like Jeopardy. You said when the price is going up, buy a call.
You buy a call, right? So that's correct answer. You get a gold star on that one. And do you know where to get out?
No, that's one of the things I'm working on with my plan is my entry level and my exit. And those are some of the things that I call them opportunities, having opportunities.
I like your style, opportunities. So walk me through an opportunity where you're going to take advantage of a security going up, and let's try and help you fill in the missing holes. Is that a good exercise? What do you think?
Okay, that's great.
Okay, so what do you normally trade?
Okay, SPY.
Okay.
And well, yes, I've been working on SPY.
Let's go with SPY. You trade SPY, I'm going to trade KGB. How about that?
Oh, okay.
walk with me here now. Walk with me here.
Okay.
So, or I'll be good. I'll trade MI5, MI6. So you want to SPY, and your thesis is that price is going to do what?
Now I'm on my phone, so I'm trying to see. It's hard for me to see because I'm not on a laptop.
Okay, but I'll tell you where the current price is. We are at 412.35.
Okay.
And the likelihood that we're going to be going down is present. We could also be going up. I don't know. So,
okay.
But we can work on two theses. You should always have two theses at at all times. You're either going up or you're going down. So you do your math for two things, and then based on what the market is telling you is happening, then you execute just one side of that thesis, right?
Yes.
So with the price being 412, and let's say that your target price is maybe 400.
Mm-hmm.
Talk to me. How do you do that? What when you get in? How do you figure out how you're going to get out?
Okay, so I would go to my my options chain and look at in the money and see where it's at. Now, depending on, I look at because I have a small account, so I'm not trying to blow my account. So I'll look at the options chain and how far, whether if I want to do in the money for that day or look at either 30 days or 60 days out, looking at based off of, it's probably wrong, but I base it off of my, how much I can afford.
Got it. Okay.
My account. I don't want to, I'm not going to spend $400 on the options with a small account.
Understood.
Okay.
So what is a small account? $1,000, $500?
$1,000.
$1,000. So you have $1,000 to spend. That's a whole account size. Is that right?
Yes, correct.
Okay, and you want to make a little bit of money on SPY. I think $1,000 is a lot of money. You can make plenty of dough. So let's see how we can help on this one. And you go what? 30 days out?
Sometimes
I think we lost you.
Sorry. Okay. Sometimes I do a day trade.
Oh.
Because
okay.
I haven't done too many swing trades.
Got it. So let's first fix a few things. With $1,000, you don't want to do a day trade.
Yes.
It's very lucrative or very attractive. It's not lucrative. Mm-hmm. It's attractive to do a day trade because the premiums are very low. We're talking about $200 or less, sometimes even, up to 300 at the money.
Yes.
And that might seem attractive because you're risking just a few dollars.
Mm-hmm.
And I can almost see what your thesis here is that you're expecting price to move in your favor, maybe about $1 or $2 on SPY.
Yes.
And then you're trying to make about $50. Is that what you're targeting?
Well, about 100.
About 100. So you're expecting to move a whole $2.
Yes.
And that's a hit or miss, and you have to wait on there all day long. Is that about right?
Yes. Yeah.
That's a bad strategy. So essentially what you have is two full-time jobs. Job number one is where they pay you every other Friday.
Mm-hmm.
Job number two is the one where you glued to your computer all day long waiting for $100.
Well, I'm not glued to the computer because I'll put a stop.
Okay.
Box in there, so I'm not.
Yeah, but it's still a horrible job if
yes, it is.
If just if it takes you a whole day to earn $100, right?
Correct.
Yeah, bad job. So here's what you do. Forget about the 0 DTE. Don't do 0 DTE anymore.
Okay.
Instead, what you're going to do is at least 7 DTE.
Okay.
Yeah? Now, if we go 7 DTE on my computer right now, I've got 6 and I've got 9. So I'll probably pick the 9.
Okay.
So I'm going to hide the 6th February. I'm going to go with 13 February. And assuming, let's first go look at the chart over here. We're expecting these the 2-point drop here, right?
Yes, so we're gonna do a put.
We're going to do a put at the 412. We're going to spend about $400, 382 to be exact.
Okay.
Is this a good trade, or is this a, what do you think of this trade so far?
A put 382.
And you're targeting about $1 or $2.
Pad trade. I don't think that's a good.
It's not a good trade, right? It's not a good trade. So a good trade is one that's making us at least $300 to $500.
Yes.
Okay, so we're going to put SPY on the shelf for a little bit, and we're going to look for something else that makes us a little bit better money.
Okay.
So are you familiar with ATR? Average true range?
Yes.
Yeah.
Yes.
ATR. That's the amount of movement on average that a stock moves over the last 14, 15 days, give or take, right?
Correct.
So you need a stock that is moving a lot, right? Moving a lot, and not just $1 or $2. So let's pick another favorite of a lot of people like to trade. I think QQQ is another one. Yeah, I'm just gonna pick one out of. It's got a low ATR though. It's got a ATR of 6.75.
There's one that
But let's take a look here. What you want, in addition to the ATR being greater than 5, you also want to look at the movement, the expected movement. Have you heard that word used anywhere? Expected movement?
Yes.
So expected movement is simply the difference between the current price and the target price. Target is where you think the price is going to go to.
Yes.
So the difference between those two numbers, if you look for a minimum of 10, right? If you look for a minimum of 10, then that means that you're expecting the stock to move $10, not the premium, the stock, the price of the underlying. So let's look at 306 over here is the current price for QQQ. So 306 minus 10 is be the 296. So immediately I can see just on this, and hopefully you can see, let's see. So 306.18, 306.18 is, I'm going to call that the current price.
Okay.
Did you say you're on your phone there, Antonia?
Yes. Yes, I am.
Gonna have to get your computer, a real computer.
I have one, but I'm in the process of traveling, and so I just picked up my phone because I saw you coming on. So I wasn't expected to get on here and ask any questions, but now I'm here,
cool.
And this is good.
This is awesome. All right, so I'll do the math here for you. So we're looking at the current price being $306 and change. And if we're going to theorize here that the price is going down to kind of fill that gap and go all the way to the support, our support is sitting at 289 and change. We're going to call it just a flat 289, okay?
Okay.
You with me on that?
Yes.
The difference between 306 and 289 real quick is about $17.
Okay.
$17. Okay. That's the best case scenario.
Okay.
Best case scenario. So I call that the utopian movement. If this is a good day and price just drops and it's your day, then it should move $17. That's 100% expected movement. However, we know that things don't move like that, right?
Correct.
Things don't move there. So we need to change or adjust our expectation that it is not going to move the full $17 in one fell swoop. Instead, we're going to target about 60%.
Okay.
60% is a measurement that we have found that it has a very high likelihood, of happening. So 60% of 17 is what? So we can do the math in our head. It's about 10 point something, maybe.
Correct.
Yeah. So $10 is what we're going to work with. I'm going to go to the options chain.
Okay.
And I'm still going to go for the 9 days, I'm actually going to, well, let's stick with the 9 days. And on QQQ, if I bought at the money, this time I'm spending about $500, right?
Yes.
306 put. And we identified that we think we have a high probability of moving 10 points. And that's 60%. So
Okay.
one of your problems you told me was that you don't know where to get out. I'm trying to show you where to get out.
Okay.
So how do we calculate? If we buy low, sell high, our low is $4.52. Okay.
Okay.
Our high is where we think that the price is going to be for that contract.
Mm-hmm.
Do you know how to calculate that?
How to calculate the
movement?
high,
Yeah.
the movement.
Mm-hmm.
Oh.
Let me give you a tip here. There's something called delta. Are you familiar with delta?
Yes, I am.
Delta, all right. So delta is the rate of change of premium.
Yes.
Means that for every one change, every $1 movement, then the premium is going to be adjusted by the amount of delta.
Yes.
So if the price of the contract is $4.52 and it's going in our favor, then right now, every time it drops by $1, then that 452, we're going to add 50 cents to it.
Yes.
Because the delta is 50. By the way, when I say delta 50, I'm referring to delta, 0.50, something like that. Okay.
Yes.
When I say delta 70, I'm referring to 0.70 and so on and so forth. So it has a delta of 50, and we can say 50 plus 50 plus 50 and do it about 10 times. Is that right?
Mm-hmm. Mm-hmm. Correct.
Or we could just do 0.50 times 10.
Yes.
Which gives us what?
500.
It gives us 5, right? Gives us
Yes.
5. So if we bought our contract at 4.52, we can expect that if the underlying moves $10 in our favor,
Mm-hmm.
we can add 5 to that premium.
Yes.
So 4.52 plus 5 is what?
Shoot. You asked me that.
Well, this 4 plus 5 is what? 9.
Yes, 9.
Yeah, 9.52, right? So if we buy it at 4.52, we can sell it at 9.52. So that gives you an idea of, where you're going to sell. So how do we set this up? By the way, what platform are you using?
I'm using Thinkorswim on my phone.
Okay, good. All right. So then you can do this. We simply open a bracket order. So I'm going to buy custom, and I'm going to choose with bracket. Sorry, with OCO. And hopefully you're going to watch these at home when you get back.
Yes.
And now we're going to do +5, right? Remember we said +5 is how much we're expecting. So 5.00. Make sure it says trigger on the column that says link.
Okay.
TRG stands for trigger. And then the next one on the next box, it says plus or minus. And then the price, it says +$5.
Okay.
Okay. Right. The next thing we're going to do is adjust our stop loss. And how much do you want to risk on $5?
Oh, 20%.
20% is what?
20% of 5. That's what? 10. Oh, well, yeah, because 10% would be like 0.5, and then it would be 0.10, right? Is that correct?
Well, I don't know. You tell me.
You put me on the spot.
I know. You showed up.
So you said 20% of 5, correct?
That's what you said. I didn't say it.
Okay. All right. I got you. You're a good teacher. I like this. Here we go. 1.
So you want to risk $1?
Sure.
Okay.
I can be a miser.
All right. So let me help you out here.
Okay.
When we think of risk, we also have to think of the reward.
Okay.
And the reward here is $5.
Yes.
Most people are looking for 3-to-1, 4-to-1, 5-to-1, whatever. But the minimum they're looking for is about 3-to-1.
Yes.
So if your reward is about $5, can we simply divide that by 3 to see what that risk factor looks like? So if 5 divided by 3 is about what, 1.6, give or take? All right, those are big numbers to think about. Can we just round it down to about $1.50?
Okay, that's
what do you
good.
think? All right.
That's good.
Okay, so if out of that $5, I am going to risk 150, then that makes it roughly 3-to-1, give or take.
Okay.
If I am going to buy this contract at $4.52 and I want to risk 150, what should my stop loss be?
Hold on. I'm getting ready to tell you.
And you can round down the numbers too.
Okay.
So out of 450, you want to risk 150.
150.
So when the price goes down to how much?
So that'd be about 3.
About 3. Okay, I like the number 3. Okay, so 3 is good. So let's think about what we just said. 3.00 is your stop loss, right? It means that when you get into this trade at 4.52 or 4 point something, then if it goes up, that's a good thing. If it does not, and it goes against you, then we're protecting ourselves by $1.50. It means that if things go to hell, that's a bad way. If things go south, then we want to protect ourselves by $1.50, right? So our stop loss would be 3. If you're still looking at my screen, you notice I've got the padlock on. So here's what I'm going to do. I'm going to unlock this padlock. Okay. And I'm also going to unlock the padlock on my stop. And instead of putting in 3 there, notice that it now changes to trigger, and I'm going to protect myself here by 152. Let's make this a round figure here, 150. So I'm saying that if the price changes downwards by $1.50, please get me out.
Yeah.
Now, since this might be a swing trade, I also need to make this GTC.
Yes.
All right. Do you now understand how and where to get out?
Yes.
Watch this video again.
Okay.
You got it. All right. Cool. Hey, thanks for being our star student of the moment.
Thank you, and thank you for being kind.
No worries. And there's a whole lot more to building a good trade. What I gave you here was just the basics. There's a whole lot more to calculating and identifying what an A+ trade is. Have you ever heard of an A+ trade?
I've heard you talk about it with a lady on 2 weeks ago. She was looking to make $200 to $500, and you showed her where to get in, and you said she chose a stock that was not, it moved about $8, and you said this is not an A+. So I figured your A+ is 10 or more movement. Those are A+ trades. So anything below 10, you're considering it's okay, but it's not A+.
It's not A+. Yes, 10 used to be good. Used to be great. Now we have a little bit more ambition, and A+ has changed a little bit. Obviously, you have to change. So we've improved the metrics and the definitions of an A+ trade.
Okay.
So you want to join my class and start making $1,000 every week.
You're right about that.
Yeah. So join my class. We'll help you out. That's not guaranteed, but that's the average everybody's making. So we like it. Cool. Hey, thanks, Antonia.
Thank you.
You're welcome. Somebody had a question that I said,
It's me, Eddie. I just wanted to ask you, what is the best strategy between, the swing doesn't always work well, especially that we have a lot of news that really can influence the TA that you prepared and thought that maybe the stock might move in one direction or the other. And suddenly we have either Paul speaking or CPI coming or the non-farmer payroll coming that you did not quite well anticipate and kind of screw up your trade. What would be the best strategy to kind of advise or how to approach the market right now as it's so volatile and so unpredictable?
Got it. Got it. So let me rephrase your question here so I make sure I understand it correctly. What you're trying to do is in your normal trading, you've got your regular stops, but every once in a while, we've got some market activity that causes huge spikes in prices. That's a problem we're trying to solve. Is that right? And so your stop loss, your normal stop loss would be violated very, very quickly in those scenarios.
Kind of.
Well, not kind of, for sure it would be, because if you have large spikes, then your stop loss should come into play, right? Unless the take profit happens fast, then in that case, in which case, then that, the stop loss does not apply. But for most people, when you're trading, by the way, what's your stop loss on SPX, if you don't mind me asking? What?
I don't trade SPX, usually trade SPY and just the normal other securities, not much in the futures.
Okay, so your stop loss is what? $200, $500, $1,000? What's your stop loss on each contract?
Really depends on the amount that I'm willing to lose. Can be 10 or 20% of, let's say, $1,000 account.
Okay. So 10% of $1,000 would be $100. 20% would be 200.
Yep.
That's a very low stop loss for S&P 500.
Not for S&P though. Like I said, it can be
for
SPY,
SPY,
can be
so
Apple.
for SPY, it is
Yep.
reasonable. For SPY, it is reasonable. So here's first tip. When you know that there's going to be some, let's call it violent market activity, violent here referring to wide swings in the prices, either because we've got some rate announcements, CPI data coming out, employment data coming out, consumer price index, etc. You need to know those things, by the way. You cannot be caught by surprise. And there are many ways of finding out. Have you heard of forex.com?
Yes, I do.
Okay, it's a new website. It came out last night. Okay, make sure you look at it every morning and figure out what's happening that day. That way you're not surprised. Second is when you have those kind of red folders or activity that is going to be happening on that day, the best strategy is to sit on your hands. Don't trade at all. It is the same thing as when you're trading earnings. Have you heard of earnings?
I get burned many times.
Yeah, it's the same thing. So if you know about earnings, you should also know that when Powell is picking, it is the same thing as earnings for S&P. Yeah. So treat it the same way. Don't trade the day before or the day after. You can.
What I was referring to, Eddie, was more like, let's say you take an option and you buy yourself time, right? Like you can go like 2 weeks out or 3 weeks, but then you expect the stock to go in one direction because you have done your TA and hit the buyer zone. Now I'm targeting the seller zone. But in between, you may have exactly what you mentioned, those news that will now come and kind of basically cancel everything that you have done. And it's a reason why last year I wasn't really successful by swinging and including a lot of people. And reason why I start really learning a lot about intraday trading and scalping.
Got it. So I think I see the issue here. So 2 weeks is a very short time, by the way, on a swing trade. We teach 45 to 90 days out. Okay, so 45 to 90 days out. That way, any sort of swings that are impromptu or that are unexpected, those usually even out within a day or so, or even within a few hours. So if you have 45 to 90 days, then you shouldn't worry too much about those swings. However, you should also have the appropriate stop loss. Right? The appropriate stop loss here would be relative to how much reward you're expecting. So if you're expecting a reward of, say, $1,000, then a stop loss of, say, 300 would be appropriate. Right? Remember that your stop loss is usually relative to the reward, not necessarily relative to the size of your account. I know you said size of your account here, but I am more likely to have a stop loss relative to the amount of the reward. Because, for instance, if I have an account size of, say, 100,000 and I want to risk 10%, does it mean I risk $10,000 on a trade? No. So you can see immediately that rule will be violated, and it should be based on the reward of the trade, not the size of your account. So that's number one. If you're expecting to get $500, then it's reasonable to risk maybe $100, $150. If you're trading a security like S&P, which moves a whole lot, then $150 risk is really no risk at all. It is a gift to the market maker. You understand that that idiom there, right? If you have a risk, if you risk just a couple $100 on S&P, you're basically buying them coffee. You tell them, here's $200, go buy coffee. So your risk needs to be a little bit more. But on SPY, that's totally reasonable. On Apple, that's reasonable. You get my point. So again, the 2 weeks on a swing trade is not enough. And if you've been in a trade for 2 weeks already and you're still in the trade, something is wrong. Something's wrong. Most trades will mature within a week or so. Even when you buy them 45, 60, 90 days out, ideally, they should mature within a week. And the reason for that is if it's a good trade, meaning that you had a healthy ATR, healthy here is greater than 5, right? Healthy is greater than 5. And you're targeting a reasonable amount, and you've also adjusted for that expectation. So you're not going for the full 100%, you're going for maybe half of that or thereabouts, then that trade should go less than a week. Most trades should last less than a week. So
let me give you also another example. You remember the last time that we had the CPI, it came in about, I can't remember very well, or 6.5 or something like that.
Mhm.
But because the Fed revised the fund rate, and this led to an EV crash. Basically, everyone was expecting the market really to go up. And this is also what I have anticipated with my trade as well. But then with the EV crash was like almost nothing moved, right?
Okay, so I think what you're referring to here is, I think you're calling it EV crash. I think you mean IV crash, right?
Yeah,
implied volatility.
Because I'm speaking French also, it's IV, implied volatility. Okay.
Yeah, I understand, je comprends. So here we're talking about the premium being very high before a volatile event, and that's very common. So let me break it down here for everyone so that they understand what we're referring to. So I'm going to go to, say, S&P here, and that was a few days ago. So today being, that was Friday.
Yeah, it was kind of a couple of days ago.
Yeah. So we're talking about, explain these. I think this was this event over here. Okay, so this was Thursday, and all day Thursday the premiums were very, very high. So let me start from that point, and then we can work our way all the way to your IV crash. Before an event, when the market or the traders are expecting some strong movements in price, the premiums are usually very, very high. And you know that they're high because you can also look at VIX, right? VIX, which is a symbol that evaluates the fear in the market. It's basically a fear index. That's what it is. And it's also tradable, by the way. So when the VIX is high, it means that premiums are high. And you can expect that premiums are going to remain high until that event. But once that event comes through, and then people have a good understanding of what's going on, then immediately that fear index starts coming down. Remember, part of the fear is because people don't know what's going to happen, right? They don't know what's going to happen. And so they tend to either hold on to their trades, or they hold, hold on to their cash, or hold on to the stocks. And once that happens, then the volatility comes down. And that's what IV crash is all about. If you look at the options chain, and every day we have a measurement of what the IV is. So on SPX, actually on any trade, basically any symbol, if you look at on the right side of the options chain, you're going to see implied volatility, and this number changes. But more to your point, when the Fed started speaking, that IV started coming down because people now understood what's happening. It was a 25 basis points increase. But what you were saying was more important than the 25 basis point increase. We already knew that that's what the increase was going to be like a month ago. No big deal. In fact, we knew about it in December, right? Because they had already given us a hint about what they were going to do in January. That wasn't the big deal. The big deal was, what were his sentiments? This is very subjective, because when IV happens, the market will respond in one way or another. Do we know whether it's going to go up or whether it's going down? Well, it went up momentarily for like 3 candles, give or take, and then it came crashing down and eventually ended up. So how would that have related to premium? If I looked at the premium on that day, say this premium that is now costing $16 was probably trading at about $26 to $30, right, per contract before the announcement. Once the IV crashes, it comes down to normal levels. So if you bought a contract when the IV was high, even if price did not change, you lost money. And it's for that reason why we do not buy during the volatile events. We want to wait until after the event, until the IV has, or the volatility has come down to normal levels. One good indication is watching the VIX and seeing come back down to, say, below 20, or below a significant, whatever the rate was. During the day, you can see whether it's positive or negative. And if it's going negative, it means that the prices are going up and the premiums are going down. Okay, there's an inverse relationship between those. Kind of a long-winded answer on that question there. I think we need to be a bit more specific. So we're not going to spend a lot more time on that. We probably need to get together and break down some of these things. Otherwise, it's going to confuse a whole lot of people who don't trade these every day. Sound good?
Thank you, Eddie.
You're welcome.
Eddie, before we do VIX though, is VIX considered high when it's greater than 20?
I think it is high, yes. So when it's greater than 20, generally we consider that high. Over 22 is, super high. But 20 and below is considered normal, all the way up to 14, give or take. And that puts us into the territory for where we buy leaps, right? Leaps are long-term equity anticipation securities. Those are options contracts that we buy 18 to 2.5 years out.
And you said that's at 15 to 20?
Yeah, 15 to 20 is a good time to be buying leaps. Obviously, you have to also look at the index, the stock itself. Make sure that you're buying low.
Got it. Thank you.
You're welcome. Cool. All right, we've got a few more minutes on these. Anybody else got a burning question or a question we need to take a look at? I'm going to stop sharing here so I can see your faces. See who's still on. Oh, it's just me who's got my camera on. Okay. Yin wants to find out how to join my class. Yes, options with Eddie. And the next class is starting on the 13th. I believe it is February 13th. Let me just double check on my calendar here. I want to say it's February 13. Let me confirm. Yes, February 13, which is going to be a Monday. So we have a class starting Monday, February 13. And that's Monday. It's Monday and Wednesday. So options with it. Hey, thanks, Tanya, for posting that link.
Eddie, can you talk about yesterday when you made your money back on SPX, how, like, looking at the 15-minute chart or whatever, how you decided that it was time to go in and make your money back?
So yesterday I was kind of all over the place. I lost money twice, almost twice, and then made it all back on this candle. I think I'm looking at the 15-minute here, right? I had a thesis that we were going to close this gap and pull back, but we failed. We failed to close the gap sufficiently.
You're not sharing your screen anymore.
We can't see.
Guess I'm supposed to have X-ray eyes. All right. Can you see it now?
Yes.
All right, good. So where is it? 15-minute. This was yesterday. I'm pointing to approximately 9:30. So I was wrong here in the first place. I thought we were going to go down. Instead, we went up. And somewhere around here is where I was trying to play defense. And I think all this time, maybe for a few candles here, I was in the red because I'd already been stopped out. I think it was somewhere here, maybe. I'd already been stopped out because I had a stop loss. And it was like 750. My stop loss is usually 2.5 on SPX per contract. So 750 was my pain point yesterday. And then when I bought a call, the gap did not fill. And I think this was, let's see, maybe you should go here to the 1 minute. Man, that's so long ago. I believe this is it. This is it. 41.80 was my target, but we were shy by just a couple cents or a couple dollars. And you know how the stock, the profit level comes up and it's, doesn't hit the mark and it starts going down. So I didn't quite hit the mark because my take profit had not arrived. And so it started going down and I stayed in way too long waiting for it to come back up and it never did. So I cut the trade somewhere around here with about $100 profit, but I was still in the red for the day because of my heavy loss earlier on in the morning. So price came down. I was kind of happy. I think I did post that. I'm glad I got out. But somewhere around here when I started, I think this was later on in the day, because I think it was just before 1 o'clock. When price started coming down, when I saw this breakout, that told me that we were going to at least cover this tent. I call it a tent. The way that S&P works and most stocks work is that it usually forms an upside down V or a V. So when I saw this drop, then my thesis was now that we're not going to break to the top. Instead, we're going to break to the bottom. And so I got in, and somewhere around here is where I made my money back. I had no idea that we were going to go all the way down. So Dora, if I had that idea, if I had that knowledge, then I would probably have stayed in the trade. But obviously, once you get positive, you jump up and down, you get out of the trade, you close it, and I wasn't even checking email that day. So Yeah, that was my idea there.
Thank you.
Sure. Yeah, but the lesson they learned was, a couple of things. First off, even when you have a good thesis about what you think is going to happen, don't be so sure as not to have a stop loss. You got to have a stop loss, right? You must have a stop loss. So my stop loss kicked me out. If I did not have a stop loss, this is a strong movement. This is a really strong movement that I would probably have been down, way too much money, right? Way too much money. So, yeah, stop loss saves lives. Marlon, you need a bumper sticker that says that, man.
On it.
You're on it? Yeah, stop loss
Working
saves
on it.
lives. Or a t-shirt. Who's into t-shirts? Sonia? Sonia, you into t-shirts? Or Clyde? There you go. All right, cool. It is 12:46 my time, Eastern time. I'm guessing here we're running dry of questions. So once again, next class is starting February 13. It's a Monday. You can join. We're going to be going over fundamentals all the way to advanced strategies. The key or the goal of those classes is to get you unstuck. It is to get you moving in the right direction and actually making money. That's the goal. Weekly income is what we're looking for. Consistent weekly income. And we're looking for strategies that can help us do that. You'd be surprised what kind of strategies that we have. They're not complicated, but you need the proper mindset, you need the proper knowledge, and you need the proper setups. We're going to be doing a lot of waiting as opposed to a lot of trading. We look for trading about 3 to 4 times a week, making about $1,000, $1,500 a week to start with. That's on one contract, by the way, just one contract. And once you make that consistent, then you can scale up as your account allows. Any questions on that? Cool. Awesome. Let me look at the chat to see what's happening. All right. Thanks, Yin. How do we say that? Do you say that Yin, Yanni? How do I say that?
It's Yan, the E is silent.
Yeah. Okay. Messi. I can say Messi. All right. All right.
Yeah.
Very cool. Very cool. And no relation to the footballer called Messi, right?
Unfortunately not. I won't be here.
You'd be having people trading for you, right?
Exactly.
I know. But you're welcome. Thanks, Toki. Great class. Thanks, Tanya. And Emily. Yes, Emily. I haven't seen Emily in a while. Good morning. I'm still waiting for you. When is a good time? Hey, contact me. You have my phone number. Just give me a call. This is somebody sending me a direct message. So yeah, just give me a call and let's talk. You have my phone number already. All right, cool. All right, with that, I want to thank you all for joining me on Saturday, and we'll see you in a couple of weeks. And if you need help, just go over to Options with Eddie and sign up for a quick 20 minutes with me, and let's talk about that. So that 20 minutes is not really a coaching call. In fact, what it is it's a way to just figure out, is this a good fit? So Toki says, I'm out. She's borrowing my words there. Thanks, Toki. All right, guys, I'm out.
Thank you.
You're welcome.
Thank you, Eddie.
All right. Bye-bye.